Let's discuss on the fourth topic, which is the internal credit rate and the risk measurement for the part of risk management series. Here we are going to discuss on the topic of internal credit rating or the probability of default, loss given default, exposure at default, and the expected loss, then unexpected loss, rating aggregation, and the economic versus regulatory capital things. That thing we are going to discuss in detail in this video series. So let's start discussion on first what is a internal credit rating. So, guys, the internal credit rating is a bank internal method to assess the borrower risk. So, in the bank, the core business of bank is to take money from you has the deposit or the saving account or the casa balance or the fixed deposit, and to lend this money to someone in the form of personal loans or the lending in the form of loans. So there is a rate of interest difference. That's the basically the income of the bank. Okay, so bank need to, there might be chance the bank will give you loan and you might be default the loan. So there is a borrower default role. So you are not eligible to pay the principal and the interest to the bank, and bank will lose the money. So that's why bank will have some internal credit ratings for their borrower, and they create is that the borrower is eligible for loan or not, given the loan or not loan, defaulter or non-defaulter, and how much the repayment capacity of that borrower. So accordingly bank will give you the loan. Since the borrower are grouped into the risk grade, so like the low risks, medium risks, high risks, continuously monitoring will happen on the basis of risks. So the bank have the risks rule based grade, low risks, medium risks, and high risks, and then the use for loan approval and the monitoring. So they will, you know, once the loan is given to the someone, so they need to continuously monitor their civil score and their the repayment capacity, timely payment will happen, and accordingly rate of interest will vary from your the repayment capacity. So let's move on the, these are the internal rating system, credit rating system bank will have. So let's discuss on the IRB approach, which is the Basel approach. So basically IRB approach stand for the bank use internal model to measure the credit risk. So bank have their internal model, or the financial intelligence unit suggests them some the rules for to measure the internal rating. Bank have their own internal ratings. On that basis they define the probability of default, loss given default, or the exposure of default to the borrowers, and accordingly they will charge the interest rate. So helps to calculate the capital requirement. How the IRB approach will help the bank to calculate the capital requirement, how much the capital bank should have while they are run their the daily businesses. So these are the things are the bank which is important. So let's step by step discuss what is the probability of default, loss given default, and exposure of default. So first one is a probability default. So probability default is a stand for the chance that the borrower will default. When bank will give someone loan, so she is a borrower, how much the chance, what is the probability that borrower will define. If the borrower probability of default measures is high, then the probability that borrower will default chance is very high. If the probability of default is low, then the chance of borrower will default very low. So that is the the it's the uh, it is the relationship between the probability, not inverse relationship, for the probability of default and the borrower of default measure over the year. So every year bank will calculate the probability of default for the each borrower, and accordingly manage their rate of interest. If the default probability of default is high, then the rate of interest cover will be get high. So then the loss given default. So loss given default is help bank to calculate the loss suffer if the default is happen. So whenever default is happen, so how much the recovery value or the how much the collateral amount that bank can recover from that defaulter. So that's where the loss given default the bank will calculate, and it should show as a percentage of the loss the bank will uh, uh, calculate. So the the loss given default is very high, then the bank will suffer the very high default amount, and the loss given default is very low, then bank if the borrower is default, then bank will low uh, very less amount, bank will lose the very less amount. So let's move on to the exposure of default, so where we are uh, it's also called as EAD. So where the exposure of default basically stand for the amount outstanding at the time of default. So what how much the amount the pending has, that so how much the amount that need to be recovered from that, so that will be calculated at the exposure at default, and include the expected future uses. So what are the future uses and important for the projects in India and the infra. So exposure at default is a very important term for the projects and the infra loans. So that bank will do the internal credit rating. So let's discuss on the product of the probability of default, loss given default, and exposure or default is the expected loss. So basically, what is the expected loss? So let's discuss on that. It is and the normal and average credit loss that's done by the bank. It is, I already told you, it is a product of the probability default and loss given default and the exposure or default, and it covers through the pricing and the provision. So accordingly, bank will charge from you in the form of interest rate, or in the form of the they have different rates, so they will cover from that the expected loss. But there are the two types of loss bank can bear with the loan is expected loss and unexpected loss. The unexpected loss is a very complex to calculate, and the unexpected loss is loss above the expected loss. The loss which bank, it's so very complicated to determine the bank, so that's the expected loss and occur during the trace scenarios. Whenever the trace is there, then the unexpected loss will bank will occur, and it is a very difficult to calculate the unexpected loss and cover by capital. So this kind of loss bank will cover by the capital. So let's move on the next slide, that is a rating migration. So where we have in this slide we are discussing about the what is a rating migration. So rating migration is basically stand for the moment of borrower risk taking grades. So there are the different types of grade which we can see. So triple A rating, triple A plus rating, double A, A rating, triple B rating. So whenever the risk is migrated, so if the customer is go from double A to triple A, it's a good. If triple A to double B, so accordingly the interest rate will vary by bank to bank. Whenever the risk is migrated, and upgrade and downgrade the default and use an early warning fools where tools where the bank will continuously send warning to the borrower and get the timely repayment. So accordingly risk migration will happen. So let's move on the next slide, which is the economic versus regulatory capital. It is also the most important for the banks to manage the economic and regulatory capital to run their daily businesses. So economic internally calculated things that done by the banking internal team, that will calculate a daily basis, monthly basis, or the yearly basis. Regulatory has per the RBI and Basel rules. So they have some RBI and the Basel some rules and the logics or the business cases. On that basis they need to maintain their the capital requirement, they need to maintain their the probability of default, loss given default, exposure or default. So Basel has or the RBI has defined some rules for the market risks, credit risks, operational risks or liquidity risks, and that need to be satisfied by the bank, and bank have its own the rules or the regulations, and both the important for the banks, both the rules, economic and regulatory capital requirement bank need to follow, and these both are the importance for the bank. So let's conclude the slide what we learn from that very important slide or the lecture, which is the internal credit rating and the risk measurement. So what we learn, so we learn the internal rating improve the risk control for the bank, IRB parameter quantify the credit risks, and the strong capital ensure the bank's stability. So banks should have the strong capability and they have the good measure for the credit risks for there. So these are the end of that slide. If you are interested guys in the market risk, credit risks or operation risk field, so please do like and subscribe my channel. I am continuously creating videos on this topic and help you to get the better job in the private and the public sector industry, so you will get handsome salary. So thank you so much guys once again attending this video. Thanks guys.